Hello everyone, how are you doing? Welcome back to the last meeting covering chapter 11 for this semester. For chapter 11, technically it is a hard chapter if you take it with, I don't know, in other classes, other instructors probably. But I have a good, easy way to take care of this chapter 11, and I'm going to show you. This is something that I came up with it, and it helped me to get the job done in the shortest way with limited time in the middle of certification exam, let's say CPA exam, or even a course exam like this one. So I'm going to teach you this, but don't think this is going to be the way I show you available somewhere else. It is my specific way of doing this cash flow preparation for our operating activities under indirect method, and I would like you to see it and then learn it and take it with you either in this course, use it, or if you want to take a CPA exam one day, definitely take a note. Remember this, it's going to save you a lot of time. So let me start with the system that I use to prepare operating cash flow for indirect method. Okay, so under operating cash flow, indirect method, we're going to focus on indirect method. Direct method, it is a little bit harder. It is less common to be used. If you use direct method of operating cash flow, then GAAP says it's fine, but you need also to show the indirect method. So it's a double work. So companies, they just like to do less, right? So they just provide indirect method operating cash flow, and that's accepted by GAAP and good enough. And it's easier too, right? So I'm going to show you how to do it in a systematic way that I came up with. Your book might show something like this, but it will make it so complicated that end of the day you will say, what? So here we go. Just listen to it, and 4 steps, you are done. In the operating cash flow indirect method, means indirectly, you go to income statement, you pick up the net income from the income statement, and indirectly you find out what is your actual cash flow from operation. Remember, cash flow from operation is coming from income statement, right? That's what you do in your operation, right? That's the concern. So what we do, we go to income statement, pick up the net income, and we put it at the top of the operating cash flow calculation with a dollar sign. Let's say $1 million. Then we have 4 steps to follow. Step 1, any depreciation looking in step 1 and 2, you are looking in the income statement. In step 1 and 2, you are looking in the income statement. In step 3 and 4, you are looking in the balance sheet. Okay, balance sheet of last 2 years. This year balance sheet and last year balance sheet. So in step 1, you go to depreciation in the income statement or amortization expense, figure out how much is it. And because those are non-cash expenses, so technically you add it back to the net income because they are literally non-cash expenses. So step 1, go to income statement, pick up depreciation expense or amortization expense, add it back to the net income. Step 1, depreciation, amortization expense, add it back to the net income. Simple like that. Step 2, look in your income statement. If you see any gain or loss, those are again non-cash recognition of gain or loss. Why do you have a gain or loss? You have a gain or loss because you are, let's say, selling one of your old equipment and you recognize a gain or loss, let's say. You might say, okay, when we're selling old equipment, then we get cash, right? So how come you say gain or loss is a non-cash activity? Yes, if you sell your equipment, used equipment, it's a cash transaction. However, that will be recognized in investing activities. Investing activities are those activities that you invest for long term, like buying equipment or selling used equipment. Buying equipment, you pay cash, that's a cash outflow. Selling equipment, it's a cash inflow. But that will be recognized in investing activities. Has nothing to do with operating activities. In the operating activities, in the income statement, you will recognize a gain or loss, but that is a non-cash gain or loss. Okay, so since gain or loss, it's a non-cash thing. So if you have a gain, you do the opposite, which is minus. If you have loss, you do the opposite, which is a plus. So let's say you have a gain of $150,000 on selling your used equipment, then you do the opposite, which is minus 150,000. So you deduct it from your net income, because gain makes your net income higher by 150, but because it's non-cash, so you deduct it. So step one, depreciation or amortization, add it back. Step two, gain or loss from the income statement, do the opposite. Step three, go look at your current asset. Current asset relates to your daily business operation, like supplies, inventories, accounts receivable. Any current asset, any change in current asset, you do the opposite. Let's say if your inventory has been decreased, then you add. If your accounts receivable has been increased, then you deduct. I'll give you an example so you understand. If your accounts receivable has been increased from last year's balance sheet to this year's balance sheet, has been increased by $250,000, that means you did not collect cash. That's why you take it out of your net income, because technically you did not collect cash. Remember, we are preparing a cash flow. Yes, your net income is 1 million, good for you, but your accounts receivable increased by 250. That means you didn't collect cash. And that's why you deduct it. Make sense? If your any current asset, if there is a change in the current asset, you do the opposite, bottom line. That's all you need to remember. Any change in current liabilities, you do also same. Current liabilities, you do same. That means if your accounts payable has been increased by 70, then you do exactly plus $70,000. Make sense? Make sense? So any, let's say you have wage payable. If your wage payable has decreased by $30,000, then you say minus 30. Why is that? I tell you an example. So an accounts payable, if it has been increased by $70,000, right? If accounts payable has been increased by $70,000, that means you did not, let's say you did not pay for those increased liabilities. So you did not pay for it. The accounts payable has been increased, then you do the same thing. Wage payable, if has been decreased, that means the cash has been paid for it. if cash has been paid for it and your wage payable has been decreased compared to the last year, then your cash has been technically decreased, right? Because you paid portion of your wage payable compared to last year balance sheet. And how do you bring your wage payable down? By paying for it, paying cash for it. So that's why it is at $30,000 minus. Anyway, all you need to remember is in part 3 and 4, changing current asset, you do the opposite. Changing current liability, you do the same. So if you remember all these 4 steps, depreciation, add it back. Gain or loss, opposite. Current asset, opposite. Current liabilities, same. You do all this, you add or deduct from your net income, and you will get cash flow providing by operating activities, 800,000. So as you see, your net income was showing $1 million, but your actual cash flow from operation was $800,000. So all you need to do, don't get confused, 4 steps. Depreciation, add. Gain or loss, opposite. Current asset, changing current asset, opposite. Changing current liability, same. That's it. Take a note. That will be good for your course. That will be good for your CPA exam. Piece of cake, easy operation. You can do this in matter of a minute instead of 5 minutes compared to other students. Okay. So now I just want to do one problem. And that is problem 10. Problem 10 is part of your homework anyway, but I want to do it so you can see the whole thing in one page. So to prepare financial statement, cash flow statement, company name goes at the top, name of the report goes in the middle, and proper date. You pick up the net income from the income statement, $79,000. You put it at the top with the dollar sign. And then you go through the steps. Remember, I said there is 4 steps. Step 1, any depreciation or amortization expense in the income statement, you add it back. Step 1, depreciation or amortization expense, add it back. Step 2, any gain or loss in the income statement, you do the opposite. Do we have any gain or loss in this problem? No. So you skip it. Step 3, any change in current asset, you do the opposite. Any change in current asset, you do the opposite. So if accounts receivable has been decreased, then you do plus 15,000, opposite. If inventory has been increased compared to last year balance sheet, then you do the opposite, minus 16,000. If prepaid rent has been increased compared to last year balance sheet, then you do the opposite, minus 3,000. Step 4, any change in current liability, you do the same. Increase in accounts payable, you do the same, plus 15,000. Decrease in interest payable, you do the same, minus 6,900. Increase in accounts payable, you do the same, plus 4,000. Then you add them up and you have net cash flow from operating activities. You can do this in matter of 1 minute in a CPA exam or in my course exam. And everyone else is spending 5 to 10 minutes for such a problem. You do it in 1 minute. Got it? Okay. The next thing is cash flow from investing activities. Investing activities are those activities that you spend money or cash comes in because of long-term investment, like buying equipment. So if you purchase equipment, obviously you paid cash for it. It's given information to you. And that's why you put it minus 110,000. If it says we purchased equipment by signing a loan, mortgage, then you don't put it in here. You put it at the bottom of the cash flow statement as a note regarding non-cash financial and investing and financial activities. And then you explain that we purchased equipment by signing a loan. But in this case, you paid 110,000 cash, so you have to show minus 110,000, which is a cash outflow, and that will be your only investing activities. Then, in regards to financing, so that's any cash outflow or inflow because of financing. You do two ways financing in your business. Either you finance using equity financing, issuing stock, or debt financing, which is borrowing money. If it is borrowing money, it's a cash inflow. It's a positive. If you pay off your liability, then it's a cash outflow, negative. If you issue stock, it's a cash inflow, positive. If you pay dividend to those stocks, then it will be a negative cash flow because you are paying dividend. Bottom line, the net cash flow from financing activities in this example is minus $145,000. Then you add them up, 235 minus 110 minus 145. That gives you net decrease of $17,900 in your cash. Now listen carefully. You go to last year balance sheet and you see how much cash did you have last year balance sheet, 126,800. But this year you had a minus 179. So minus 79 plus 126, that gives you 108,900. You go to this year balance sheet and you have to have exactly 108,900. Anything besides this number in your balance sheet, that means you made a mistake here. This is how you check your work. Is this 108,900 is exactly equals to your balance sheet, 108,900? Good for you. If not, that means you made a mistake here. Okay? And if it is exactly 108,900 in your balance sheet showing, then double line $, case closed, job done. Congratulations. Got it? That's all you need to learn how to prepare a cash flow statement. Easy peasy. Not easy if you are reading the book or taking other courses with other instructors, other colleges. But I told you an easy way that will save you so much time compared to others in preparing a cash flow statement, which everyone is confused, making mistakes, but you are doing it just like nothing is going on. Why? Because you are following those 4 steps. And this is the hard part of it. If you follow those 4 steps under indirect method, it will be an easy process. Anyway, hopefully you learned this, and hopefully you use this technique in your cash flow statement. Thank you so much.